All right, folks, we'll go ahead and hop right into it then. Welcome to the second part of a series around community economic development innovations for a post-pandemic economy. We'll be doing this bi-weekly. Now, I represent University of California Ag and Natural Resources Cooperative Extension. We are kind of we're the campus outreach for our university system in California. Not only do we work in California communities, but we work across the nation. We cover a bunch of program areas. Most folks are familiar with what we do in ag. I'm on the economic development side. Hello, everybody. For those of you who don't know me, I'm Keith Taylor. I'm a cooperative extension specialist in community economic development. In other university systems, we'd probably call that an extension professor. So what it means is, unlike my other colleagues who teach on the university campus, I go to California communities. I work with them on research, development, and educational issues around community economic development. One thing I want to acknowledge up front, for those of you that were here before, you're going to see some familiar slides. This is just to kind of get everyone reoriented. I do want to acknowledge that our current representation in our speakers is not diverse, and we are working on that. We had a number of things that popped up that kept us from having a more diverse speaker base. But I wanted to reassure folks that we're working on that for the next iteration of the series. And the University of California, Davis and Cooperative Extension has a number of resources and initiatives that are trying to address this diversity, equity, inclusion gap. So that is absolutely on the forefront of our mind. So in addressing this issue of why it is that we need to have innovations in economic development during and after the pandemic that we're going through, I want to say up front that a lot of folks have been speculating that there's going to be some permanent structural changes in our economy that's going to arise due to the pandemic. But I have some questions about that. I mean, obviously we had a massive drop in GDP and unemployment, and we had disruptions in hospitality as a major area. However, what we've also seen though is that there were some structural issues that were set up way in advance of the pandemic. And these structural issues just seem to have been exacerbated due to features of the pandemic. One of the things that I think is remarkable is looking at some of these corporate cash hoards that's out there. So there's Warren Buffett. Everyone likes to talk about him as, the Oracle of Omaha. He's currently sitting on $145 billion in cash. Apple is also notorious for its cash hoard. They're sitting on $196 billion. So why does that matter to you, to everyday folks, to folks in the business community, and folks doing economic development? What that means is that's money that's out of the economy that's not going back into supporting local enterprise, that's not supporting the workforce, that's not generating new sources of revenue and new sources of economic activity. This is a real problem, and this was well in advance of the pandemic. So what's on the other side of this, right? Well, what this means is we keep on digging into our economic development toolbox, and you can see we have all these tools that are out there, but we keep going for the same tools over and over again. And largely what those tools are: traction retention, workforce development, the creative class, and industrial clusters. And I'm not saying we should reject those, not by any means. Instead, what I'm saying is we need to buttress those. We need to complement them with other approaches to how we do economic development. Right now, the way that we're doing economic development reinforces these features of investor ownership. So this means if you have a lot of money, you can play in the economy. Our presenter today, Matt Cropp, is going to talk briefly about some of the things that have been in the news lately, like Robinhood and whatnot. It also tends to be paternalistic. It's very top down. This then crowds out a lot of entrepreneurship from the bottom up. If you go to a lot of the rural communities that I work in, you'll see that a lot of businesses are struggling and they need sources of capital. They need new investment. They need support systems, but we're not collectively investing in those resources. This then constrains how we do economic democracy, the ability of people to participate, to be entrepreneurs, to have ownership over slices of the economy. So this is our series. This is what we're working on. 2 weeks ago, we had Professor Martin Kinney. Today, it's going to be my colleague and friend, Matt Cropp, presenting. And you see we've got 3 more of these lined up for the remainder of this series. And so today I'm really excited to have Matt Cropp present. Matt will introduce his topic area, but I think that it's a really important thing that Matt and the folks he's working with out of Burlington, Vermont have been innovating, which is this idea of grassroots community capital. So these investment co-op clubs, also investing in commercial real estate properties. So without any ado, I'd like to hand it over to Matt Cropp.
Thanks for having me for this, Keith. One moment, and I'll just start sharing my little slide deck here. All right, so yes, I'm Matt Cropp, and my day job hat, I wear a few of them here in this presentation, is as the Executive Director of the Vermont Employee Ownership Center, which is a nonprofit that focuses on promoting and fostering what we would define as broad-based employee ownership, which is ownership of firms by kind of all of their employees through things like ESOPs, worker cooperatives, stuff like that. And the other two hats I'm here today with are as kind of in leadership of these two organizations, the Vermont Real Estate Cooperative and Vermont Solidarity Investing Club. So both of these are groups that have kind of come together in some ways out of starting to understand some of the gaps in terms of this kind of sustainable place-based social and economic development work and how to sort of mobilize grassroots capital to fill them. So we'll cover a few of these models, and then certainly happy to have any discussion questions. But first, I just wanted to kind of acknowledge that we're in an interesting moment for small investors kind of seeking agency. And this is not the first time historically we've been in a moment like this, but the whole Wall Street bets, GameStop, Robinhood app stuff that's been on the news really has been these small investors finding ways to coordinate to basically mess with the institutional investor that was engaging in a short sale situation. And that kind of almost swarm approach is something that that in a lot of ways is related and similar to what we've been seeing in terms of things like cryptocurrency speculation, where you have these technologies designed to basically route around the kind of legacy financial systems, regulatory barriers, and all of that, allowing for these quick flows of capital in and out, whole kind of subcultures, meme cultures. Things that really engage people, not purely on a financial level, but also on kind of an identity level. And so, this is one manifestation of this, looking into kind of some historical examples. There's a great book that was written during the sort of .com boom around the turn of the millennium, where that was an ethnography of investment clubs in Silicon Valley. So these things emerge and these cultures kind of emerge from time to time. But I think, especially in the context of the pandemic, the same kind of impulse can also be channeled away, not purely into speculative, things that are half fun, half just get rich quick schemes, but also into sustainable and equitable local economic development. So in this presentation, I'll first talk a little bit about the role I see for grassroots capital, what I'm defining that as, and the roles it can play. Then I'll get into kind of dissecting the investment club model a bit, as well as the sort of the real estate cooperative model, and with some discussion of the ones that I'm involved in, just so you can get a practical sense of what they are, how they function, what role they can play, and what it takes to get one going. And then move into questions, discussion, and happy to sort of go in a variety of directions on that front. Before I get into sort of the role of grassroots capital, I just want to define it a little bit. And I think that it kind of exists in this intermediate ground between, on the one hand, there's things like CDFIs, community-oriented, other types of community-oriented financial institutions that are intermediaries that people are interested in having their money be invested in such things, can put it in, kind of set it and forget it. Doesn't really require any involvement. So I see that as an allied thing, and we'll talk a little bit about the ways that these clubs and real estate co-ops can interface with those, but it's kind of a separate category. And then the other side has been the emergence recently of a lot of kind of infrastructure around equity crowdfunding, direct public offerings that are really, again, about more of the swarm of individuals, but without kind of necessarily much in terms of organization, right? Everyone's acting as an individual investor. So the things I'll be talking about today are kind of in between those two categories of these things that are, it's a form of collective action of individuals, but that requires at some level their participation beyond simply financial participation, but not sort of purely kind of in that more swarm mode. So I'm going to start with just a little overview of when you're thinking about this kind of local investing, kind of comparing it to the sort of conventional investing that most people who are in society who have enough resources to invest will tend to first engage in, oftentimes through, say, a work retirement plan like a 401k or something else like that. So on the one hand, you have kind of the conventional investing thing, which is, you tend to invest in things that are public markets, right? They're highly liquid. You can easily go in and out of these sorts of investments. Whereas with local investing, it often looks like private investment, notes or equity or other types of vehicles that go into these companies that you're often not quite sure when you might be able to get money out. The kind of classic sort of portfolio theory of investing, really highlights and is very positive and on kind of diversification, and in the index funds as the sort of almost platonic ideal of, okay, you can just own a piece of every publicly traded company in the S&P 500 by putting $10 in an index fund. Whereas with local investing, it's more difficult to diversify. There's concentration of risk, both in terms of, okay, well, what if there's a natural disaster in one place versus having be investing in the whole economy, and different places tend to sort of have specialization, so you're not going to get all the sectors of the economy. With conventional investing, right, there's easy access with retirement vehicles. Your 401k will have a bunch of default things. You can just throw your money into bond funds or index funds or growth funds, et cetera. Whereas for that kind of tax preference investing, you need to get a little more specialized and focused, with things like self-directed IRAs or solo 401ks, that sort of thing. So there's kind of an incentive for that sort of tax advantage savings that we're all incentivized to do in the United States, to sort of push it away from local economic investment and towards kind of that national market scale thing. And then with conventional investing, it's often purely financial considerations. Maybe there's a little bit of ESG, kind of socially screened funds, that sort of thing. Okay, let's see if which of these large oil companies that we're going to invest in has more diverse representation on the board of directors, et cetera. But ultimately, that fiduciary duty piece is really core. Whereas with local investing, there is a lot more chance to pursue multiple bottom lines and impacts in ways that kind of feed into that question of, okay, as an investor, do you actually have agency, or is this purely kind of a commodity, financial relationship with what you're investing in? So, that's generally, it's a little harder to invest locally. And a little bit more risky oftentimes and all of that. So why do it? And I think there's three points to make here that I think are useful to think about. One is, and this is again that question of people who are looking for agency, looking for an opportunity to have an impact on the world, right? It's visible. It can be significant. You can see what could exist or not exist in your community as a result of your actions, especially your actions in collaboration with others. And that default setting of being able to just flow money into Wall Street through tax preference retirement vehicles means functionally we have a system where publicly traded companies are overcapitalized, and and those that aren't tend to structurally are undercapitalized. So this is an opportunity to reverse that a little bit. Information, right? So the fact that you're embedded in communities, you have knowledge of local conditions, and people and sort of the players in the community, which can inform risk assessment beyond the sort of rationalized things that credit scores or other things like that, and decision making for, and do I want to invest in this particular thing or this other thing, right? And then the question of, okay, it's not purely a financial relationship. You're in community with these other economic players, and so you have an opportunity to influence their success, not simply through capitalization, but also through other forms of interaction, whether that's introducing people, social capital, bringing business to them. There's a classic example in Vermont, the early days of Ben & Jerry's, where they did one of Vermont's first kind of direct public offerings, and they would invite their small stockholders to the opening of the new scoop shop. So they had kind of community cheerleaders for their expansion, and that sort of influence is something that when you're one billionth of a particular company's owner is much more diluted. So in terms of the roles that this kind of grassroots capital can play, I think one, and this is somewhat drawing on my experience with the Employee Ownership Center, but one is really kind of filling gaps in conventional financing, right? So you can see things where a group can come together and say, all right, well, there's this, say in the example of stuff that we do, there's a group of workers who don't have a lot of wealth who want to sort of buy a business from a retiring owner. Okay, there's a certain amount of collateral, certain amount of conventional lending can fit, but they don't have quite the equity to bring to the table, and that owner maybe wants to have doesn't want to hold the whole rest as kind of a seller's note. So this sort of thing where there's community relationships and trust could mean, okay, there's a loan campaign that comes to the table and can, with subordinated debt or equity or other tools, fill in the difference, right? Similarly, for high impact startups, that sort of risk capital can be challenging for even kind of mission-based CDFI type lenders in many cases, and the ability to have this kind of people who are kind of in community with those who are trying to sort of start these kinds of place-based businesses can make a big difference in sort of the tipping point of whether there's enough capital available. And then the idea that what we're talking about pools not just money, but also power, right? It builds relationships among the people who are involved in the organizations, and it can actually be something that as new problems in the community arise, the sort of relationships of working together in this context can translate into even entrepreneurial ventures. And I'll talk a little bit about how that played out in Vermont for us. So I'm going to start with talking about the investment club model. So investment clubs have been around for many, many years. I think the sort of first example people have talked about is like, all right, there's something that was formed in the late 1800s in Texas. But they kind of exist with a carve out in securities law that allows for these kind of small groups to pool their resources. And in the past, kind of before the advent of low-cost online brokerages, most of them tended to be kind of stock picking clubs where people would pool their money, do some research on stocks, and then buy the stocks or bonds or whatever, and kind of share the cost of the brokerage fees. So in some ways, almost like a little buying club, but for investment. So to fall under the regulatory exemptions, the club needs to be fewer than 100 people. And it needs everyone to be participating in the decision making. So what that means you can't do is have someone who's a paid advisor come in and say, all right, I'm going to make the decisions for you. The club needs to make the decisions together. And so one of the barriers to a lot of kind of small scale community driven investment is the sort of regulatory restrictions around things like accredited investment and that sort of thing. And so this can be a way to allow for people to invest in certain things, not necessarily things that require accreditation, but say, having, there are certain types of offerings that maybe up to say 35 non-accredited investors can come on. And in the same way that, an investment club might have been, pooling people's resources to afford the brokerage fees, it can also be pooling to, afford to get one of those slots. So for folks who are interested in forming a club, this is kind of the sort of roadmap to get one together. And so generally you want to find at least 4 founding collaborators. There's another rule around no one can own more than 25% of the company. And oftentimes that can come out of an existing project or community, something where you've already got some trust and rapport together. It can be more challenging to just throw up a flag and say, hey, I want to start an investment club. Who else is interested? It's certainly possible, but that kind of having that core base that can then kind of snowball out to find more members, I think, is a kind of speeds up the possibility of success. Then you get together, you develop some agreements and policies. Generally it's going to be either an LLC or a partnership, right? So you have an LLC operating agreement. We inherited one from another investment club and modified it accordingly. But generally having that kind of core group, that steering committee, work together and sort of lay the groundwork for the organization. When that's done and you've kind of reached out and you sort of have your founding group together, you form the LLC or partnership. Most that I've been aware of have used the LLC structure. And then elect officers. In our case, we have 3, and that's been sort of good for balancing the sort of limited volunteer administrative work. Chair, who's responsible for running meetings and signing checks when we make investments and things like that. Secretary, who's responsible for kind of onboarding with people, generating some reports, filing things with the Secretary of State as needed, and then the treasurer, who files financial reports, deposits any income that we get, things like that. So a relatively equal division of labor, and then we've kind of rotated some of those positions over time. So once you got all that together, then you actually make the investment. And the sorts of investments that these kinds of organizations can look at if you're focused on local investment is oftentimes things like loans, but you can do royalties, guarantees, stock of various kinds. Our club focuses on cooperatives, so we tend to do non-voting preferred stock, and convertible notes, which start out as debt and can become equity in certain contexts. And then inviting your network to invest with you. So generally, it tends to be something where it's you want to have, if you start kind of publicly, actively recruiting, you can start to go into, you're offering a security and then you're violating securities law. So generally think, DMs, talking to people who are in your network or friends of friends, right? Kind of that snowball recruitment approach that can sort of broaden the group as you go. So quickly, the story of our club. So we were inspired by a group called Co-op Principle in Minneapolis, which had adopted the investment club model with this target of specifically only investing in cooperatives. And so I was part of a group that was very interested in organizing cooperatives in Vermont, and this seemed like a great idea for a way to channel our group's energy into something kind of material. So the folks in Minneapolis provided us with documents and some mentorship in our startup phase. And then we actually, so the Colorado Solidarity Fund, in turn, we sort of provided our modified documents to them and some mentorship as they got going. So there's kind of been this pay it forward vibe in that community. So our club, the Vermont Solidarity Investing Club, was founded in 2016. We have 27 members now and 60,000 in assets, invested in 9 co-ops and funds. We're set up so that every member commits to making a monthly investment into the club of between $20 and $200. And we just kind of use an ACH pull to pull that into our account. We aim to meet approximately every other month. We've been doing that on Zoom since obviously the pandemic started, but have tended to do things. Say this is, you can see on the left a picture of us at Burlington Co-housing, where we would kind of do dinner and then have our business meeting after dinner. So kind of really making sure that it had this both social component as well as being strictly business thing, because we're kind of building this community of practice together. So the Colorado Solidarity Fund was founded 2 years later in 2018. They similarly had kind of a co-op study circle, and so that kind of co-op movement connection was really sort of how we had connected, and they've kind of learned about what we were doing, what Co-op Principle was doing, and wanted to start one of their own. So they have 68 members. They, instead of doing the monthly thing, do basically annually. They open up and allow people to make an investment once a year. So they do it in bigger chunks rather than a monthly thing. Thus far, they've invested in 3 cooperatives. They have a number of folks in Colorado who are Spanish speaking, so they've made a real point of trying to have translation at meetings and build a lot of relationships with different kind of community organizations in the neighborhoods that they've been investing in. And they've been doing kind of meetings more like about once a month. And really, again, sort of, I think there's a vital thing around this kind of building this basis of trust and relationships among the members that is the foundation for being able to work effectively together. So one example of an investment that our club made, just to kind of make it very concrete, is As Real Pickles, which is a worker cooperative in Massachusetts. They make, as you would assume, pickles and various pickled products. So one of our club members heard that they were doing an offering, and because we had a personal connection to them, that again allowed, as I mentioned, allowed for a certain number of non-accredited investors to invest. So we received the documents, reviewed them, decided we wanted to invest. The terms were basically non-voting preferred stock to help them kind of expand and to build a bigger facility and a solar array. So we receive a 4% dividend on that stock, and then it can be redeemed at face value after 5 years. So our decision-making process looked like we had sort of a subset of club members review and discuss the offering, look through both their financials and kind of what the terms were. Then we put forward a proposal to add the offering to our approved investments list. Once that passed, we basically then have this list of investments that are currently open that we are up for investing in potentially. So then we did an allocation of liquid funds, which I'll show you kind of what that looks like in a moment. But basically, have people vote on, okay, if we have, say, $10,000 liquid, here's the options. Where would each person like to prioritize our investment? And then we sort of take those the results of that vote, turn it into a final proposal, and then that's put forward before the members to ratify. And so we use the Lumio platform, which is a kind of forum that allows for a number of different kind of polling options as our sort of main communications tool for the club. And this is sort of one of our first investments from very early on that I had used in another presentation, so I had a screen cap of it. But basically, in this case, we had three investments. Each member received 10 dots, each representing $250 of the $2,500 that were available to invest. And there were three options, right? There was kind of keep money in our savings account, put some money in the Cooperative Fund of New England, which is a CDFI loan fund that we can kind of earn 2% interest at, and they lend to other co-ops. So it's kind of our semi-liquid savings account. And then, or put some money in the Burlington Herb Clinic's preferred stock offer. And so basically then, at the end of this process, we ended up deciding, okay, the way all the votes turned out, to invest $500 in that particular project. So, in terms of the benefits of membership in one of these clubs, there's a few kind of from the individual perspective, right? One is the question of deal flow, right? If people are interested in investing locally, but aren't really part of a broader community of practice, oftentimes it's hard to find the opportunities for investment. So we have 27 members who are, in the case of our co-op focus club, our work in different wings of the co-op movement. There's people in credit unions, there's people in worker co-ops, there's people in ag co-ops, housing co-ops, et cetera, as well as people who are just interested in cooperation and do other things. And so we're listening with many ears, and anytime any one person hears about something, the whole club knows, right? There's the opportunity for deeper investment analysis that both a number of people can look and see and bring their kind of unique knowledge, both of the community that the business is in and also, the particular sector it's in, et cetera, to sort of allow for vetting and make the decision to say, okay, yes, we want to do this, or, oh, I see some risk here. And we have good conversations about that. We haven't invested in everything that's come across the club's plate. So, it's really sort of a good opportunity to not just run away with your own imagination, but get reality checked by other people. And it also kind of creates this education community of practice element, which is both, there's a number of people in the club who are very sophisticated, have worked in finance or worked in kind of cooperatives and have a good understanding of these things. And there's other folks who are supporters, but this is their first time investing other than maybe doing their 401k match at work. And so there's this opportunity for those new folks to learn and build their knowledge. And then there's also the sort of, and I'll talk more about kind of how this played out with the real estate co-op, but the opportunity to start sort of building trust with each other on a smaller scale type project where the stakes are lower, but understand who you might, in that group, might be a collaborator who, for a future sort of entrepreneurial project, you might want to appreciate working with. And then finally, there's, for individuals, the kind of the opportunity for sidecar investment. So generally, our club's rule is that if the investment comes before the club makes a decision about investing before any members are allowed to make personal investments as well. But oftentimes it'll be something where, okay, the club's maybe going to make a $5,000 investment in this thing, but there might be 3 or 4 club members who then make an additional personal investment. So it kind of, the impact can be large. And so, now I'll move on here and talk a little bit about the real estate co-op model. But the connection here with the club that I mentioned is that we had learned about a real estate co-op early on and thought, hey, wouldn't this be a cool thing to have in our community? And that sort of vague sense was sort of put on the back burner, but that vague sense of, yeah, if the right opportunity arises, we should do that, kind of existed within the club's community, and conversation for probably 2 years before an opportunity arose where it really made sense. And so at that point, a subset of people who were part of the club and had worked together on that for a few years decided, all right, let's kind of do some groundwork, lay some groundwork, and let's see if we can start one of these things. So the basic definition of this real estate co-op idea is consumer cooperative holding company that mobilizes capital from community members and tenants to purchase and operate rental properties. And so you might have heard of like housing co-ops, and it's perhaps like an allied thing, but a little bit different in that housing co-ops tend to focus on one building or complex. Obviously it's purely residential rather than kind of allowing for both residential and commercial kind of real estate. And it's something that once it tends to hit a certain scale, it says, okay, we're administering this particular thing. Whereas the real estate co-op, because it's bringing kind of both, it's bringing probably significant community investment in, is more kind of growth oriented than a typical kind of housing co-op, which is a little more instrumental in its approach. So a few key ideas for this real estate co-op structure. So the first thing to really understand is the consumer co-op structure generally, of which this is a subset. So other examples of consumer co-ops are, food co-ops, credit unions, certain co-ops in the agricultural sector. But the core idea, in shares of co-ops in general, one member, one vote governance. So you own a share, and you might invest more capital, but no matter how much capital you've invested, you still get one member, one vote, democratic governance. The second piece is a fixed share price. So this is not a thing that allows for windfall gains, but rather you say you buy a share for $1,000. If you decide to leave, and the co-op has the ability to cash you out, you're cashed out usually at the same amount. Consumer co-ops are designed, and this is an important piece to understand, as to operate on a not-for-profit basis towards their members, which functionally means that profit is distributed on the basis of, in this case, rent paid. So the term of art in the co-op world is the patronage refund. But essentially, if you have $10,000 worth of profit and 10 tenants have each paid $1,000 in rent, just keep it simple, not realistic, then each of those is going to get 1/10 of the profit share. And so, and then the other thing that's important to understand about this is that most co-ops, and this is very state by state, so it really you really need to look at your state's laws in order to understand exactly how that works. But generally, the equity, and in some cases, sort of also certain forms of investment in cooperatives have pretty significant securities law exemptions. And that in particular means that you oftentimes don't have to do a very high overhead kind of direct public offering type filing. You can keep the sort of legal costs down, and so therefore you can kind of have an initial thing that's much smaller scale, and then start to scale up versus like needing a certain minimum viable scale for it to matter or to work. So one other thing to understand here is the kind of idea of limited return on investment capital. So that patronage refund is, an ideal type co-op has no external capital obligations. All profit goes back to the users prorated by how much they use the co-op. Practically though, for this to grow and to be able to secure properties, it's going to need to sort of bring some capital in, and and co-ops are designed to allow for that to a certain extent, but limiting and subordinating that capital to the purposes of the cooperative. So the real estate co-ops tend to have this kind of capped target annual dividend, and no exposure to sort of like capital gains on the sort of valuation of the property it goes up, right? Your share is still worth $1,000 each year, and in the case of our real estate co-op, and we say, okay, the first slice of profit before we pay a patronage refund, say 5 or 6% target, goes out as just a dividend on capital to the members, on their shares. And then there's this sort of idea of permanence, right? So the goal is really to buy and hold properties, not to flip them, right? You're not trying to sort of just make these capital gain things, but you're sort of investing in community and hopefully holding the space for generative purposes over a long period of time. Of course, there's certain exceptions. Maybe it's just not working and there's an opportunity to have higher impact somewhere else. You might sell a particular property to use the capital for a better purpose. But they tend to have things that are built in to disincentivize simply like, oh, the value of our property doubled, let's smash the piggy bank and take all this out. So for instance, our co-op's bylaws are poison pilled, so that if it's ever liquidated, basically everyone gets made whole and a year's worth of dividends are paid. But any sort of windfall beyond that has to be donated to kind of housing, to cooperative, affordable housing, or local food system nonprofits. In a way that's kind of decided in a participatory way by the members of the co-op. So it disincentivizes that kind of short-termism in a way. So it's a small but growing movement of these types of organizations. The Northeast Investment Cooperative has been around for a number of years in Minneapolis. In California, the East Bay Permanent Real Estate Cooperative is actually raising money right now, and they're doing a national level offering that allows for people from a number of states to invest, which has been quite interesting. I was just looking at their offering the other day as I was putting this together. So that's kind of an exciting scaling moment for them. And then the Vermont Real Estate Cooperative is the one that I'm the board treasurer of, and which recently closed on a building and actually sort of spun off a second real estate co-op. So there's 2 buildings in Vermont that are owned this way. And so similarly to the investment club, I'll also give a little sort of overview of, just an example of a transaction. So this building, 88-90 Oak Street in Burlington, was a small cafe and a sort of mixed use, has a 3-bedroom apartment upstairs, had a small cafe and a commissary space that was used for a restaurant group in town. That restaurant group outgrew this, and so the owner decided they wanted to sell the building, but kind of decided that they wanted the exit ideally not to be something that would just cause it to be sort of totally redeveloped. It would keep its local food system focus and other things like that. So there's some values considerations involved. So the building owner had talked to 2 restaurant sort of startup folks who are have been doing pop-ups but hadn't had a brick and mortar kind of location yet, who are interested in potentially sharing the cafe and commercial space. And approached the Vermont Real Estate Co-op, which was in the process of looking at purchasing another building as a first building. So there's some discussion in the real estate co-op about whether we wanted to take on 2 buildings at one time or separate into 2 entities. The latter decision was made. So we formed a separate real estate co-op really to focus just on this building. We did a public campaign recruiting members, and we got about 75 individuals, 1 co-op and 1 nonprofit, all put in at least $1,000 to purchase the shares. And overall, we raised a little over $200,000, which covered both the down payment and working capital. We also had there's kind of a credit union that's very kind of friendly to cooperatives in Vermont that we considered approaching because they actually have an equity co-op equity program, but ultimately decided to apply to them for a mortgage. And they were willing to give us a mortgage on very good terms for a startup business that had no previous track record, which really helped sort of make sure that we were the finances really worked to get this thing off the ground. So we closed on the building. We were supposed to close in March of 2020. Obviously, things happened in March and it got kind of delayed for a few months, but which in some ways was a blessing in disguise. It helped the businesses pivot their business models to say, okay, they're focused on carry out rather than some in cafe dining and that sort of thing. So we closed in June 2020. After doing some renovations and other things, that's been fairly successful. We were able to pay the first 6% dividend on the equity investment to the members. And then we've also created our framework for buying back some of the equity. So creating an opportunity for liquidity for folks, which basically says anytime the cash reserves of the organization gets above a certain target level, those are available first to buy back. There's some preferred shares that had come in from a couple of the family members of the business owners who are the tenants. And then once the preferred shares are paid off, then that kind of additional surplus will be available to sort of buy back member shares from the voting members as they request them. So they don't have to sell them back, but if they would like to sell them, we'll start creating a pot of money to do that. And so, so as we look forward, we kind of, just balancing a few things, right? It's the, how much do we want to, quickly as we can pay off the sort of external obligations, how much do we want to sort of envision improvements to the building, doing efficiency things. We've replaced the windows and done some extra insulation, and we're talking about solarizing and other things like that. So there's interesting discussions being done by the elected board, which has seven people on it who had been meeting once a month, now meet quarterly, to sort of continue to sort of evolve the vision of what we're trying to accomplish with this building, and to think about, as more opportunities arise, what does the next thing look like? How do we support that and make it easier for these things to continue happening? So I'll kind of leave the fire hose of information there, but I'm certainly happy to to field any questions, and if folks are interested in following up after the presentation, you can just shoot me an email at matt@veoc.org, and always happy to have conversations about these sorts of things. And yeah, so I'll just kind of open it for discussion and questions.
Fantastic. Matt, this is great. What I'm going to do here is just briefly share my screen. I want folks to be aware of the next webinar that's coming up here. So in 2 weeks, we have Kevin Short, the CEO of Anza Electric Cooperative. He's going to be talking about how their nonprofit, low margin electric co-op is able to deliver on microgrids, renewables, and broadband. So especially when it comes to California's utilities issues, especially when it comes to Biden's infrastructure investments, this is going to be a very relevant presentation. I'll make sure I put the link to it from my Twitter in the chat. But otherwise, Matt, before we hop into the Q&A, and I encourage folks to add some questions here, I have one thought on this, and that is, me getting this faculty job. Now I'm in this world where I've got a pension and I got a 401k, and I'm one of those folks who the passivity of investing makes me nervous about, okay, you see these ups and downs in the economy and you don't really have any control over it. And I'm looking at it going, wow, the investment houses are putting a bunch of bank into institutions that I think undermine community businesses. And so this model, to me, it feels like a way where even if I'm not going to get a return in terms of cash or in terms of a monthly salary, I'm building up community assets that, if something happens to me, there's going to be greater welfare in my local community. Do you have any thoughts or reflections on that? Am I correct in my interpretation?
Yeah. Well, I think there's multiple layers to it, right? And there's kind of the question of what is the return that you're looking for, right? And the stuff that I've kind of worked on this front, I think, there's definitely a place for the kind of philanthropic approaches where, if you're in the position where you can give a bunch of money to, a nonprofit land trust, that go for it. That's awesome. But I think that there's this sort of balance of for most people who are kind of like at more not in the sort of independently wealthy mode, but might have some savings, is that you're going to need to have some level of financial return to just kind of secure your future retirement, because that's how our social economy works, right? But at the same time, you realistically, like, you can also sort of prioritize some other things. And so this idea of, all right, aiming for things like with the real estate co-op, like a 6% return or something like that, that gradually, can be bought back over time, and then you put the money elsewhere, I think is, in my mind, sort of hits that fair balance of something that is that's building community capacity and building community resilience, right? This building is something that's not going to be just arbitrarily taken out of use because someone who doesn't live in the community like put some numbers in a spreadsheet and decides that could be better used, demolished, and turned into a couple of luxury condos, right? There's some level of kind of accountability and some democratic process to how do we want to use this property that we now all own together in a democratic way. So I think that there's that question of like, what is retirement security? And Janelle Orsi at the Sustainable Economies Law Center just came out with a great article, and I think the Harvard Law Review, about ERISA and the retirement system and how it really kind of incentivizes people to undermine, essentially, like, how you have to invest in ways that undermine a livable future for all of us. So I think there's a lot of conversation to be had just on the retirement front as well. And I really encourage people to check out the Sustainable Economies Law Center's Next Egg project as a great resource for that side of things.
Fantastic. And Matt, we have a number of questions here in the Q&A box. So if you don't mind, I'd like you to work through them. So as you read through it, if you don't mind just reading it out loud and then responding.
Mm-hmm. Okay, so from Taylor, looks like thoughts on cooperative farming and real estate clubs. So this is something that's certainly come up for our organization. I think it's really just like almost anything else. To a certain extent, it is kind of like a is there an opportunity to get something going that's commercially viable if with the sort of constraints of the real estate cooperative. So we've had some folks talk about like, oh, would this be useful for creating, for holding the land that a farm could be on, or and I think there's some other interesting models like the agrarian trust and other things that, again, there's some tax advantages to sort of nonprofit like land trust ownership of land versus kind of direct ownership in certain contexts. So I think that I think there's a lot of potential there, and I think there's also the potential to think about, okay, what does your club or co-op want to specialize in? Do you want to specialize in, is housing a big issue in your community that's going to mobilize people? And so that's what you should focus on. Is it agriculture, and you see that there's an opportunity there, or, similarly, like with our investment club, we're focused on co-ops, but I've heard of ones that are focused more on just like very sort of narrow, small locality, or renewable energy, or other sorts of things. So I think to a certain extent, it's kind of driven by what do you see as the needs, and how can you kind of organize people sort of around those in a way that can have some impact.
Fantastic. And Matt, just for the California crowd here, there is some pretty remarkable agricultural land trust out there. The Marin Agricultural Land Trust is something that I've only recently heard about. And I guess they own something like 50% of the land in Marin County. Really impressive. So those kind of models, they're out there. They're doing some pretty robust things, and engage with them and see how we can merge these models together, I think would be a useful conversation. So next, Matt.
All right, so the next one was from Jesse, was where did that money come from to upgrade? So for the upgrades on the building. So there were kind of a few things, right? One was when we were buying, we kind of budgeted some of the like, okay, this building's been in use for a while, like it's going to need some refresh. So we budgeted some of that just into our kind of starting working capital. We had a $10,000 landlord kind of contribution to sort of a new paint job, and we also kind of were able to find some kind of renewable energy incentives and things around putting a heat pump in, and we were able to actually get, I think, like 75% of the cost of the installation and new windows covered by kind of a local energy efficiency program. So there's some of that. And then the other piece is just thinking about how much of the rental income, do we want to be setting aside for kind of reinvestment in kind of improving the building, right? Because, the amount that's being extracted as investment income is inherently capped by our bylaws. That means we have some room to play with some of that money to sort of envision, okay, what's the best thing, and what goals do we want to have? Do we want to sort of move this building ultimately towards net zero? Do we want to, try to make sure that, for the residential tenants, we don't raise rent more than, inflation and things like that. So there's definitely some both like values and kind of practical considerations around that sort of like reinvestment versus kind of investment in expansion, and, how do you prioritize those things? And it's a conversation within the board, and then even within the membership at our annual meeting and stuff like that.
Fantastic.
So then Raymond Jin, so do you have any advice for early career folks who might not have the large network needed for a full investment club? Well, I think there's two things here. One is that, you can really, for the investment club thing, you can really start fairly small, right? It could be something where a couple people, you form an LLC, you all put in a few $100. You maybe initially put that money in a local CDFI just to start to, earn a little bit of interest and be having a little bit of impact, and gradually grow the pot until you're big enough to start making more serious investments. But I think the other thing too, that for ones that I've seen that tend to be successful, it tends to be sort of, the investment club grows out of another kind of allied network or organization. So in our case, it was this Cooperative Vermont group that had been meeting for years, talking about, oh, do we want to form a federation of cooperatives in the state, kind of an organization of organizations. And ultimately the club was formed after the group came to this conclusion that, well, most of the needs that a federation would serve are kind of being served at the sector level, right? The worker co-ops have their little organization, the credit unions have their organization, et cetera. But that there was a group of individuals who were really sort of passionate and interested in this kind of co-op economy development stuff, and that this investment club was actually a good vehicle for kind of continuing that community of practice that we had built together, and actually sort of putting some money and resources behind it, right? I feel like there's a lot of things where you might have a sort of an interested community that does a reading group or study group or something like that. But there's definitely a different dynamic when it starts to be actually everyone's putting resources in and you're collectively stewarding this pool of resources that are intended to do something, right? Intended to have an impact, but also, but are not just being given away. It's you're kind of creating this collective pool of capital together. And so I think that to a certain extent, having an existing organization or network or something that can see this as an additional way of advancing their goals along with the other strategies they use can be a fairly powerful thing in terms of jumpstarting this. But really, like, it could even be you get together, there's a half dozen folks and you get together and you start something, and then every once in a while you invite a friend and invite them in and all that. And that's I think a perfectly legitimate way to get something like that going as well.
Matt, Olivia here has a really great question that I think speaks to sort of our unique niche and our unique knowledge of these various community-based partners that are out there that could potentially play out. So if you wouldn't mind, just address what Olivia has here.
Yeah. So again, sort of for the real estate co-op stuff, I would the East Bay permanent real estate co-op in California got a lot of I think kind of structural support from Sustainable Economies Law Center in terms of like how it was designed, like the legal design and things like that. So I think that for California in general, that's it's a organization I respect a lot, being 3,000 miles away. In terms of things that actually kind of for us in our ecosystem were supportive, certainly having the credit union I mentioned was a really kind of key thing in terms of being willing to, for our first deal, come to us and be like, all right, we'll give you a mortgage that has like a 30-year amortization, not like a 30-year term. It kind of resets after a shorter amount of time, but like a 30-year amortization, which is not common for commercial mortgages, especially for brand new businesses. But they, we had a relationship with them through kind of broader co-op movement activities, and so there's a certain level of kind of trust and credibility that was pre-existing, and plus there's kind of a principle of co-ops helping co-ops. Another player that was actually a little bit helpful in terms of kind of promotion was our local food co-op for the Oak Street project, where they offered to say, invest it, buy $5,000 worth of shares, but do it in a way that was saying like, okay, we'll match the next $5,000 that you raise in your campaign. So they kind of posted a little thing on their Facebook page and their Twitter account and all of that, and sort of helped kind of raise awareness, beyond the just what we were able to do. And there was, I think, also an interesting dynamic for the real estate co-op around the tenants, where this was an opportunity to secure real estate where they're still renters, they're paying rent, right? It's not like they have free space, but it's kind of like a fair relationship that they can feel comfortable that they'll have access to the space over the long term, and that it's not going to become an extractive relationship, right? And so they felt comfortable going to their networks and saying, hey, if you want to help us get this thing, get our businesses started, you like our, Cafe Mama Juana has kind of had become well known as doing these catering pop-ups with Dominican food. It's like, you want Dominican food every week, like consistently? You want to support my business getting going? Help buy the building that I'll be in, right? And so that kind of that sort of finding the folks who really would be impacted and saying like, okay, well, let's combine networks. And so it wasn't just the usual suspects in the co-op world that I'm more connected to. It was also the people who had come to Maria's pop-ups, and the people who were excited about the little sandwich shop that was going to go in, and people who are kind of concerned about high rents in town. So in some ways, you're forming a coalition of people that these sorts of vehicles can then become a way of taking aspirations and making them reality.
So Matt, we have 4 minutes here, and if folks have any more questions, feel free to put it in. We've only got a limited amount of time, but while we're waiting to see if anyone wants to ask another question, One thing I think about, Matt, is on the surface, something like this could look like it's very intense. It can look like there's a lot of participation that's required. I know from knowing you and knowing this model that it's far more flexible than that. So can you speak to those, as we say, governance and management cost, like
Yeah.
the level of the degree of participation and how people can participate and choose to at whatever level?
Right. So for the investment club is definitely the higher level of participation model, where you do have that requirement that everyone sort of participates in the decision-making process. I mean, the reason why we use that Lumio program that I showed you is because it does allow for, rather than an old style investment clubs, it was literally you get together in person at every meeting, and that's where decisions would be made. So really everyone had to come to the meetings, right? Versus something where we say, okay, well, we'll have a meeting, we'll discuss this thing synchronously, and then we'll put the decision out so that everyone has access to the decision, whether or not they've been able to make a particular meeting, right? And they can see the minutes of the discussion. People can discuss kind of along with their voting, kind of why they're voting a certain way. So while everyone does need to participate, it definitely means it's a lower level of kind of commitment than it would be if we were meeting in person once a month. The real estate co-op is something where, as a consumer co-op, there's an elected board that kind of takes the lead on things, and then we have a few committees. So we probably have, of the 75 members, there's 7 who are on the board, and then there's probably another 5 or 6 who are not board members but serve on a couple of the committees to sort of help with operation. There's an operations committee, a finance committee, and a member engagement committee. And so that's something where people can can just choose to, all right, I'll vote for the board in the board elections once a year, and otherwise kind of go get my empanadas when I want them. But it's something where it's more the commitment. The people who are committed to the activity is a little bit more narrow. And one thing we're talking about is, as we mature, right now the board is all volunteer, but talking about, I think for some level of kind of accessibility and inclusion reasons, providing some compensation for board work is a good thing, because then it's not just people with purely free time, but okay, well, even if it's a few $100 a year, that can make a meaningful difference for some folks making the decision to participate or not. So we're starting to have the conversation around that, that question of, as we mature, maybe first starting to kind of provide a little bit of compensation for sort of board work, and then ultimately, if we hit a certain scale, at what point do we bring on a paid staff person or things like that?
So it's to say that as time goes on, you can innovate approaches to participate. You can meet the various needs of various stakeholders. You can use things like Lumio. You can meet in person. In the future, as it matures, you can even have paid staff that guides a lot of this for us.
Mm-hmm.
Yeah, that's great. So we're coming up here on the hour. Matt, this is fantastic. Really appreciate you taking the time here. Folks, those of you that are asking, we're going to have this video posted. We're going to have resources up. I believe that Matt's also going to have a Google Drive with some of the documents from the finance co-op and the real estate co-op, so people can understand how this has been structured. That's going to be released here probably within the next week on the official UC A&R website. So look forward to that. And if you can be back here in 2 weeks, that would be great, folks. So thank you all so much.